Right. Hello again. I hope everyone's looked over part one of the real estate investment model. And so I'm going to go into part two here and just go into a few more additional features you may or may not. I mean, to add, probably will want to add to this, but we've got our cash flows, the main thing that we did. I cleaned this up a little bit. You can present this in any fashion you would like. These are the main things that we built. There's going to be some additional features I'm going to add to help you improve on your knowledge of how this kind of works. So the next part I'm going to do is our cost of capital, and I'm going to add that down here. So this is kind of similar to how you would do it in a business model. Cost of capital. Okay, so we're going to build out what we need. So our cost of debt, debt's the easiest one, and the weight of debt. And then we're going to have our tax rate. And then we're going to have our weighted after tax cost of debt. And then we're going to have our cost of equity, and then our weight. So we know that we don't know our cost. We know all of this actually. So we know our cost of debt is the interest rate on debt, and that was up here in our financing assumptions of 4%. And our weight we know is 80%. Go up to here and not there. We can hit that. Okay, and we just want percent there. Tax rate was 25%. Again, we don't really need the tax on there because we've already defined that. Okay, so the formula we're going to use here is the cost, the after-tax cost of debt is going to be the weight of debt times the cost of debt, and then it's going to be multiplied by 1 minus the tax rate. The reason we do that is because the interest payments on debt reduce our taxable income, which is a good thing because that means interest is lowering our taxes that we're going to pay. So it acts as like a tax shelter. So the cost what that does is that's a benefit to us. So that it takes away kind of a cost feature of the debt by lowering our tax rate. So that's why we do that. Equity, on the other hand, does not give us tax deductions. So when we have to do, maybe you're more familiar with dividends that are paid out. So when let's say Apple pays out dividends to its shareholders, that is not a tax deductible feature, but its interest payments to its debt holders is. So that is the reason this is included here. So this is going to equal 4% multiplied by 80%, just the weight, multiplied by 1 minus the tax rate. Okay, so we get 2.4% is our weighted costs. Okay, so we know the weight of equity is just 1 minus here. We did that earlier, and we don't know the cost yet. Okay. Now, this is where you start getting into maybe some assumptions, but down here I'm going to do the cost of equity. Let's do the expected cost of equity, because this is going to be some assumptions here. So there's a formula called the capital asset pricing model, and that says that the cost of equity equals the risk-free rate, which would be the usually the risk-free rate is government debt, so with treasury bonds. So we would use something maybe similar to our investment horizon. So we have a 5-year return, so we could use maybe the 10-year, because that's a usual one that we could use. So we'd use the risk-free rate, and then we plus that to the market risk, so the risk of the market minus the risk-free rate. Now this thing here in the parentheses equals your equity risk premium. And there's a very important reason for this, is the risk that you take correlates with the return. So you're gonna want a higher return for more risk, okay? And that makes sense. You know, if you're, I'm trying to put this into a way that makes sense, but if you're going to give $100 to an investment where you knew for pretty much for 100% sure and you're going to get your money back and you're going to get some return, versus putting your money into something where you may or may not get that money back, you're gonna want a higher return. It's like gambling, for example. And let's say you're going to gamble $100, and then you've got 50-50 odds on one, and then you've got 10% odds on the other. You're not going to be willing to invest as much into the one with lower odds, but you're not going to invest the same. Okay, so if you had $100, you're going to invest in the one with 50-50 chance and the one with 10% chance. If they had the same payout, there would be no sense to invest in the one that has a 10% chance of winning. You would just take the 50% chance of winning, because you have a greater chance of getting your money and the return. So the only way to be persuaded to invest in the riskier asset is for a higher return. Okay, it's the same deal here. So this market risk return is the difference between the return in the markets that usually we use an index, the S&P 500, and then we take out the risk-free rate, and that's how much that's the amount we expect to earn over the risk-free rate for investing your money into a riskier asset. And all of that is in the parentheses is multiplied by the beta of the asset. And this only works for publicly traded securities, because the beta is the correlation. It's how the certain asset, the subject asset, so if it was like Tesla, how Tesla moves against the market and return to the market, because the market has a beta of 1. So if Tesla, I think it has a beta of about 2 right now, that means for any one one unit, let's say $1, so let's say if the market moved by $1, Tesla would move by $2, because it's got 2 times the beta of the market. So if it went up $1, Tesla is going to most likely go up $2. If it went down $1, Tesla is going to go down $2. And it's based off historical data, how the volatility of the stocks. The more volatile a stock is, the greater its beta is. Well, I should say how volatile it is in comparison to the market. So that's what that's. I mean, so if a stock has a beta of -1, it means it does the exact opposite of the market. So we'll get into that a little bit more of that in a later unit. But for this, I've kind of modified this formula a little bit, so we can kind of use this. So this is just how I'm going to get my cost of equity. Now, this might not be the most accurate way to do it, but this is about what I would expect is your cost of equity in a real estate deal. Now, another thing I should talk about is the where it slipped my mind at the moment, the order of who gets paid first. So debt holders get paid. That's the priority rule. Okay, so debt holders get paid before equity holders. They have the first claim to the assets. So the bank in this case is the debt holders. They're going to take the asset in default before the investors. So say the equity in this deal was put forth by investors, then we would do this model, what I'm showing right now. Now, if you're investing the money yourself, the cost of equity could be a little different. It could be more the opportunity cost. So most likely the opportunity cost would just be what you could earn in the market. So you're going to have a very much lower. But let's assume we're getting investors to do this, because we can take this model and apply it to, you know, $1 million of assets. So for a multifamily, maybe like an apartment complex. So let's say we're raising equity for this deal. So this is going to be around what the equity holders would expect in return, with the cost of equity of the business. So they have the last claim to the assets, right? So that kind of goes back to that gambling example I was talking about. You have a less chance of getting your money back if something goes wrong. So you're gonna require more return. Now the investors could also just go into the market and get whatever the market expects to return. So I'm going to use that as a baseline. Okay, so the market is a baseline beta of 1. Now we can use an adjusted method here where we make an adjusted beta. So based on the debt to equity. So we have 80% debt and 20% equity. So we have a debt to equity ratio of 400%. So I'm going to do an adjustment here. So I'm going to do a beta of 1 for the market. I'm going to do 1 times, and I'm going to do the debt to equity. 1 times 1 plus the debt to equity. Put an equals here. The debt to equity. Again, it's got the tax shelter. So 1 minus the tax rate. This is called the beta adjusted formula. Okay. And so I do that. Okay, so 1, 4, 1 plus that, so that equals 4. So what we're doing here is we're getting a beta of 4, and that it does sounds very high, but that is because of how much more debt we have. So the greater the debt, the more risk there kind of is to equity holders. Now their return on equity is higher because they're not getting diluted by the amount of equity, but there is a lot more risk. So now we have a beta of 4. So let's put this here. The beta equals this. It equals 4. And then let's do the risk-free rate. Now you could go look this up now. I'm just going to use 2% right now. But you can go up and look on the daily treasury rates and figure out what the 10-year is, or whatever one you want to use. But let's just put in 2% right now, because it's about what it probably is. And remember, this is from December, so actually it might be lower, but let's use that for now. And the market return would have probably been historically around 8%, and that's probably a bit lower at the moment. But it's been going down a lot. I think we've dropped maybe 20% on the year to date now as I'm speaking, but we'll have the historic kind of 8%. So our market risk premium is going to equal this minus this. So I've done what's in this parentheses here. So now what I'm going to do is the cost of equity is going to equal this times the beta. I'm going to plus the risk-free rate. 26%. It's quite high, isn't it? So that's going to go up to here. So it's going to equal that, but then it's only 20%. So 5.2. Okay. And then we simply, it's called the WACC, weighted average cost of, right? Weighted average cost of capital is just these two added up. Okay, so 7.6% is our weighted average cost of capital, and that's going to be our discount rate to find our net present value. So let's add in here NPV. It's going to go X equals X NPV. Take the rate, we have that here, oops, here. And our values are our total cash flows. And then our dates, and we did that up here. Okay, so 193,000. So what we've essentially done there is if we discount back all of these cash flows, right, to their date. So this is time period 0. This is 1, 2, 3, 4, 5. So the longer out we are, the more the cash flows get discounted by, because the formula is present value equals cash flow divided by 1 plus R, the interest rate, or the weighted average cost of capital, to the power of n. N is the time period that it represents. So if something is raised to the power of a greater number, so out here it's 5, it's going to be the present value. If you're dividing something by a bigger number, you're reducing it by a bigger amount, so it's going to be less, right? So we're saying if we discount these all back, then the total amount, like the present value of what those cash flows are worth, is 193,805, and that's including the initial equity we put forth. Okay, so the general rule is if your net present value is greater than 0, then the project or investment is good, because we're creating cash flow. The other rule is that the internal rate of return here is greater than our cost of capital, then that also means that our investment is good. Additionally, there is you can do the net present value divided by your initial. So I'm putting a negative in there to reverse it, so it's not negative, because I don't want this to come out negative if it's not. Your initial investment, and that gives you your profitability index. So that's giving us a multiple of what we initially inflow. So our equity, what we inject into the project, we'll get a 6.08 multiple out of that from its present value of its cash flow. So that, again, if that is greater than 1, that means we're creating more value than what we put in. And this is at a 6-fold. So we're creating 6 times. Sometimes you might see an equity multiple. This is what this is. This is what we're, now I sometimes see mistakes in real estate models where what people do is they go equals, they calculate up all the cash flows, and they divide this by that. They say, oh, it's a 10 times equity multiple. That's not right, because that's future cash flows, and the future cash flows are not worth the same as today's cash flows. So you have to do it by NPV, and that's your true equity multiple there. So 6. That's a good return. Okay, So, and then obviously these don't look too neat because of out there. So I'm going to make them white so you can't see them. But those were just for your information. So I wasn't just spitting out formulas and you watching this being like, where is he getting that from? But you can look up all of these online as well, just so you know what I'm saying is correct. Okay, so we've added the weighted cost of capital. There's one other thing I wanted, well, there's a few things I want to show you, but there's something else I want to get to as well if you haven't seen this before. So I'm going to highlight that, and then we'll also highlight interest. I'm going to go to insert a scatter plot. I'm going to call this, so let's do that, interest versus principal. Okay. Get rid of these grid lines. Like I said, I don't like grid lines. And then I'm going to select data. Give this one a name. This was interest. Is it interest? Yes. Okay, and then I'm going to add principal. My X values again, the period. My Y value is going to equal my principal payments. Okay, okay, and okay. Now, you see the relationship we have here. What this now I need to change this axis actually, just so it, what is our max? Let's see. I'll show you another equals max. Let's see. I know it's going to be 7,000 at the end, so 7,000, and our max interest is 5,000. So let's make the max 7,200. Let's make the minimum. What's the minimum we pay? About 2 interest payment. It's down to 200. It does get down to $200. So let's make this 200. 100. Right. Okay, so you see here, the blue line is interest. At the start of the loan, we're paying mostly interest. And at the end, we're paying mostly principal. They're inversely related. Okay, so that's important with real estate deals because if it's, you know, say this is a house that you're living in yourself, so you're not creating cash flow out of it. If you pay your loan off quicker, or you pay points down, which points means you're paying off interest at the beginning, you can reduce the amount of interest and start paying your principal faster. Now, the faster you pay your principal, the less interest you pay because you're paying interest based on the outstanding amount of debt. Okay, so that's why a 10-year loan or a 15-year loan and a 20-year, 30-year, the longer the term, if the interest rate stays the same, you're going to pay a lot more in interest in a longer term because you're taking a much longer time to pay down that debt, right? So, but when you have a cash flowing asset, debt is a good thing, right? So remember, our payments aren't, our interest payments reduce our taxable income, but our payments do not, like our principal payments do not. You can't write that off. So sometimes, especially if you are creating cash flow, it's better to have a longer term. You can have more cash flow and reduce your taxable income by, having a longer term. So you don't necessarily, because also remember, you have to pay these principal before you can pay equity holders. So if this was a 10-year model, we'd be paying a whole lot more in principal. We might not be able to pay out money to our equity holders. So you got to be careful in these models. You can't think of it in the same as you're a non-cash flow producing asset like your own property that you live in, because if it's your own property, yes, you want to pay the debt down faster. if it's cash flowing, you might not want to do that. Okay, so when people say debt is bad, sometimes they're right if it's bad debt. If it's not cash flowing, if it's not a cash flowing asset, then the debt, yes, it's bad, and you want to pay it down as quickly as possible. But if it's a cash flowing asset, then debt can be your friend. You know, it creates, you don't see this property here that we'd analyzed was $160,000, but we only had to put forth $31,000. The bank put forward the rest. So we're essentially getting an asset worth $160,000 for $31,000, and we're producing a return. And at the end of that term, we own the asset. So think about doing this multiple times. If you did have $160,000, you can buy one property if you did full equity, okay? But if you have this money and you only put that much equity, you can buy 5 properties, right, with that money. And then at the end of the term, you own 5 properties that are cash flowing, and you have this value that you're essentially getting. The bank, the bank is paying, your returns almost, because we're earning what is it here? We're earning a 63% return. Okay, let's put it back to the base model here, because that's where is that? Let's go base. We are earning a 35%, let's say 35% return on equity, whereas the bank is getting 4% from us. That's how much we're paying. So if we can earn more than what our debt costs, then the bank is essentially lending us money, and we're able to make more money than it costs. So we're taking on more risk. The bank doesn't want to take on this risk, but that's why they're happy to lend out the money and you take the risk. But that's just great thing about real estate here. So I have this built. What else did I want to go through? Let's see. Sometimes you might want to make a summary page and add features like this on the front, which I do with some of my other models.